The fourth and final speaker, and maybe before I say anything else about the fourth and final speaker, I've already got 3 really good ideas for speakers for next year by asking you guys for them. So I thank you. I just need one more, and I'm home free. This is great. But the fourth speaker is also an old friend of mine. He was a colleague of mine here at the University of Missouri for 14 years, and he is now a colleague of other lucky people at Brigham Young University, where he teaches personal and family finance to over 1,200 students each year, which is not that much more than we teach here at the University of Missouri, I might add, but that's okay. Craig Israelsen received his bachelor's degree in agribusiness and his MS in agricultural economics from Utah State University. And again, prior to being here, he got his PhD at Brigham Young University before he came to our faculty back in 1991, I believe it was. So he was here from 1991 to 2005. Craig is married to Tammy Trimble. They have 7 children. I think if I can read all these names: Sarah, Andrew, Heidi, Mark, Nathan, Emma, and Jared. His hobbies include, and I love this, include running, biking, swimming, woodworking, and family vacation. He has run in the Boston Marathon 5 times, but he has never won the Boston Marathon. Which is something I've never rubbed in on him because I've never run a marathon. I used to run, but my knee decided to quit. The other thing I'd like to say about Craig, not only is he an old friend and a colleague, but back in the days that he was here, and Ed Metzen was the founding chair of our department back in the 60s, the 1960s, and it had a certain development because of Ed and his interest in people and their money and helping people reach their goals. Craig actually, when he came into the department, I actually provided a real, like a spiritual leadership, for lack of a better word. That he actually, his presence was felt by the students. His advice that he gave to students, the people that would seek him out just to talk about everything, including myself, were numerous. And so I'm delighted to have Craig Israelsen back here today. Well, he's been here for 2 or 3 days to speak to us about his research and his books that he's written about investment allocation. So please join me in welcoming my friend, Craig Israelsen.
Am I live? Okay, thank you. People have asked how I'm enjoying this, and it's like dying. And these are the people you meet when you cross over the veil. That's what it feels like, honestly. So to have lunch with Ed and Anita on Tuesday night and Melanie, their daughter, one of my former students back in the early 90s, was really a rich experience. I owe a lot to... Okay. I owe a lot to Ed and Anita. I want them to know of my love for them. And my colleagues that are here. This is harder than I thought it would be. So I appreciate it. When I say colleagues, I mean those that I worked with, B. Smith, Veronica, and Brenda, just so many. And I include my students as my colleagues. I believed early on, and I still believe, that I need to behave myself because one of my students might hire me someday. And I know that can happen. I want to be worthy of their trust. So I'd like to talk about asset allocation. I'm very impressed with the presentations that preceded this. Margie, I know that Margie probably had another 4 hours of material that she could have presented, and I hope that sometime I can go visit her and talk about that. What does salsa have in common with asset allocation? We all know about salsa. We grow a lot of tomatoes out in Utah, and we make a lot of salsa. The commonality, I believe, is that salsa is 6 or 7 or 8 different ingredients. And then we combine them, and in the combination, there is a magic that happens, which is different than if we line up all the ingredients of salsa separately in separate bowls. Here's the diced up tomatoes, here's the cilantro, here's the onions, here's the garlic salt, whatever, lime juice, and say to our guest, get a big chip and dip it in you know where this is going, Brenda. Get a big chip and dip it in each bowl and then quickly chew it up in your mouth and it will become salsa. And that's not how we do it. There is a magic in the combining of the ingredients beforehand, and they kind of settle in to each other. And that is acid allocation. So if you can think about salsa in terms of a recipe metaphor, you now understand acid allocation. Because the phrase acid allocation is, it's fraught with this supposed complexity, and there's some complex elements to it, but the metaphor is quite basic. It's quite straightforward. So here are the assets that we combine to make a portfolio. We have these, quote, salsa ingredients. I trust you're familiar with these, but this is about as far back as we can go in terms of the returns of these asset classes. All of the prior speakers have spoken about assets, and these are the ingredients of the salsa. So from 1970 through 2011, the best performing asset or salsa ingredient was real estate. Now bear in mind that when I say real estate, it's not uncommon for a person to think, oh, my house. That's not the Dow Jones US Select Real Estate Index. That's commercial. This is a commercial real estate figure. And based on where you live, you might have had a good experience as a real estate investor. Santa Ana, not so much in Fargo. Of course, lately Fargo is pretty strong, but so this is commercial real estate. The annualized return since 1970 through 2011 is 11.38%. That's a staggeringly high return. That's just what that's the tomatoes, so to say. The standard deviation, 19.65, growth of 10,000. So then U.S. small stock, U.S. large stock, commodities, international stock. And Margie delivered a treatise on international stocks. And as I stand here, I'm just contemplating how I incorporate what I learned from Margie today. That's the IFA index that Margie spoke of. IFA stands for Europe, Australasia, and the Far East. And that's an index produced by Morgan Stanley Capital International, MSCI. That IFA index is a developed market index. And Margie really illustrated that developed. So you have a range of 11.38% annualized return, the geometric mean return, down to 8.87. And then aggregate bonds at just a touch below that at 8.28, and then cash. And it's staggering to consider that cash has a 42-year average return of 5.7%, when cash today is what? Point. And whenever you start a return with the word point, that's not a comfortable conclusion. And so, you know, you've heard all the negative expressions, cash is trash and so forth. It's possible that cash has always been designed to be a safe haven asset. And if you get a positive return over inflation, you're just lucky. If we rethought what cash was intended to do, maybe we wouldn't be so hard on it when it's not producing, 5.7%. But that's the Treasury bill. The 3-month T-bill return last 42 years. I want to point something out that I'm sure you all already know. The standard deviation for the 5 assets in the blue is roughly twice as large as the average return. So I could take off the titles. I could take off the words real estate, U.S. small stock, U.S. large stock. I could take those off, and you would still know that those are equity-like assets, because you would look at the correlation between the geometric mean and the sigma. And if one is twice as large as the other, you would know that that's a risky asset. That's how we know. It's the correlation between the mean return and the volatility of returns. The 2 fixed income, bonds and cash, look at the relationship. The standard deviation is 2/3 the size of the return. That informs us it's a fixed income asset class. So in salsa, some ingredients are kind of neutral like salt. It doesn't, I mean, it's really important, but it's not very exciting. Oh yeah, imagine a lot more salt than normal. Really? Don't, right? So some of the ingredients of a portfolio aren't on their own very exciting. Their job is not to be exciting. Their job is to neutralize and to dampen and to buffer. Those are the indexes. Bob Almany and I were talking, because he was asking, listening to Margie, why don't more, probably we're all asking this, why don't more fund managers or pension managers or whatever add more emerging market stock into the overall portfolio? You know, kind of spice up the salsa. Well, it's because, in my opinion, too many portfolios here in the States use as their performance benchmark the Standard & Poor's 500. Well, I have nothing against the S&P 500. It's just an all-U.S. large-cap equity index. We're talking about building a multi-asset portfolio. Since when do we compare salsa to ground-up tomatoes? That's a ridiculous comparison. But that's what happens every day. And it's called tracking error or benchmark error. And pension managers freak out when they have a lot of tracking error against a well-known, sort of deified index. That's a real problem. That's what prevents adequate, in my estimation, adequate diversification. Now, just a quick different take on risk. So we have the largest one-year gain of these 7 portfolio asset classes. And we have commodities, 74.9%. That's an impressive one-year gain. That means you're in a roller coaster car that can go that high. Well, if a roller coaster, you can finish that sentence, right? Okay. So the worst one-year loss, all of those worst one-year losses in the blue section, Jack, 2008, right? So did it really matter which equity kind of asset you were in? No. They all took a beating. More to say about that as to how they took the beating. Because these are just the numbers at the end of the year. Years don't happen all at once. They happen day by day. And that day-by-day experience is important to understand the asset class. Then the worst 3-year cumulative return. Notice that in this 42-year period, there are 40 3-year returns, correct? In a 42-year span, there are 40 3-year rolling periods. What's the worst 3-year total start-to-finish return of bonds? Well, it was 6.15%. There was never a 3-year period where you had a return, not per year return, total return of less than 6%. Now, what are we not factoring in? Inflation. Why are we not factoring in inflation? Because published returns never do. So if you go to Morningstar, if you go to Lipper, S&P, wherever you go for data, there are 5 assumptions that underlie every piece of published return data. And here they are. The first assumption, there was a lump sum investment. How many people invest with just one lump sum? Okay, essentially, very few. Most of us invest systematically through a 401k plan or an annual IRA contribution or something along that line. Second assumption, there was no additional money put in. Third assumption, no money was taken out. Fourth assumption, no taxes. Fifth assumption, no inflation. In other words, when you present returns to the world, you can't all have different assumptions. There has to be a governing set of assumptions, and those are the 5. So these numbers are then affected by those assumptions. Cash never had a 3-year return, a 3-year period of a negative number start to finish. So those are buffering assets. The equity assets and equity-like, commodities and real estate are equity-like. And when I say equity, that typically is a synonym for stock. Because as we buy stock, we're an owner. And equity is a word for ownership. All right, so those are the ingredients of the salsa. There's nothing funner than an XY chart. That was a joke. So the 42-year risk-return analysis, you can think of it as a constellation. This is the night sky. And in the northeast corner of the sky are the risk on the x-axis, the return on the y-axis. Those are the coordinates. So it's a separate constellation. The big equity, the little equity dipper, whatever you want to think of it. That's a constellation of risk-return coordinates. In the southwest portion of the sky are the risk-return coordinates or characteristics of fixed income over the last 42 years. Okay, each of these dots represents an asset class, but a portfolio is a mixture of asset classes. That's why we call it asset allocation. Isn't that stunning? So, how do we allocate these assets? I understand that the red dot has 500 securities in it. But is 500, if you grind up 500 tomatoes, do you have salsa? No, you have 500 ground up tomatoes. And that's not salsa. And if you pawn it off as salsa, somebody's disappointed. So we have created what is a misperception of what diversification is. The S&P 500 is a diversified set within a single asset class. That's not true diversification. That's intra-diversification. That's depth. That's not breadth. We would need to get both depth and breadth. That's true diversification. So when we do that, if we do asset allocation right, the ideal is to move a dot into that zone. Because whether your client or whether you can articulate it or not, we want to be in a portfolio that has relatively high return where we've cut the risk down. That's the objective if there's nothing else. So the task now is, can asset allocation, can an appropriate model, and Margie actually presented one, the regional model, I wrote it down. It's affecting how I think. I just want to come back just for a second. The bond figure, one more slide. The bond return of 8.28. Here's a return of 8.28% annualized. That's the average return per year for 42 years for bonds. Okay, that's a big number. That's a big bond return. You have to appreciate the last 40 years in fixed income has been the best 40 years in the history of this world that we have recorded. Okay, so you have to bear that in mind. And this is a picture of that phenomena. The green line are rolling 40-year returns. Each square is a 40-year average annual return. This is back to 1926, so the first end of a 40-year period, if you start in 1926, is 1945. So the 40-year average return for bonds from 1926 to 1945 was 3%. The next 40 years, 3%. It was perpetually about 0.7% return. Bonds were not viewed as a growth asset. The last 40 years, that has changed. And I think underlying a lot of the comments and presentations of Matt and John is that will fixed income, U.S. bonds, maintain this average return of about 8%? That's the underlying concern. This is the history, but will it continue, will it perpetuate? The blue is the S&P 500. Notice how erratic, even over a 40-year period. You think over 40 years you'd have a pretty smooth function? Like 40 years would smooth? The S&P, when you have big drops, minus 37, minus 29, that can really move the needle even on a 40-year period. And then the red is a 60-40, the classic 60-40 balanced approach. 60% U.S. stocks, 40% bonds. That was just an aside. That was a freebie. You didn't pay for that. To be diversified, this is an assertion. This is my assertion. To be diversified, a portfolio must combine multiple ingredients that have low correlation with each other. That's the salsa effect. Salsa, all the ingredients of salsa are typically quite different from each other. Onions are not like tomatoes. Just try slicing some for your kids. Here, have some sliced onions. Just, put some salt on it. It's not going to go well, okay? So this low correlation, we're trying to get at, okay, how are these ingredients different? Well, if it's salsa, our taste buds tell us how it's different. How about in a portfolio? Is it taste buds? No, it's a correlation matrix. And that sends chills down all the folks who didn't enjoy statistics. So we'll pass over it quickly. This is a correlation matrix. So over the past 42 years, the relationship between large U.S. stock, the S&P 500, and the Russell 2000. The Russell 2000 is produced by Russell, and it's 2,000 smaller stocks. S&P is produced by Standard & Poor's, it's 500 stocks. And just a point that Margie made, when the Morgan Stanley figures out that China is not exactly an emerging country, what a stunning revelation that will be. And then they modify the IFA index to incorporate China. It comes out of the EM index. And what she said was very prescient, which is there's a whole lot of products that now have to make a change. So this is my sub-point. Is there any product, when we say an index fund is passively managed, do you really buy that? An index fund is managed by S&P, Morgan Stanley. It's managed. People make decisions as to what the inclusion criteria are. There's really very little, if any, that's just totally, passively managed by robots. These are managed by human beings, either by committee, by rules. Just a little sub-point. 78% is the correlation between large U.S. stocks and small U.S. stocks. That means 78% of the time, this is a crude way to describe it, 78% of the time, if the S&P goes up, the Russell 2000 goes up. And likewise down. Is that a high correlation? Well, what's the maximum correlation? 1. There's actually 2 maximums. What's the other maximum? -1. Yeah, there's 2 maximums. What's the minimum? Well, it's the midpoint. It's 0. So a 0 correlation is quite wonderful. What's a -1 correlation? Does it exist? Theoretically, it does in what's called an inverse fund. An inverse fund is designed to move inversely or opposite to, say, the S&P 500. Well, think this through for a second. The S&P 500 tends to have positive returns about 70% of the time. If you build a perfectly inverse fund, aren't you guaranteeing, essentially, a negative return 70% of the time? I mean, it's kind of funny. And that's why people don't do that. They build inverse funds, but they tend to sort of, quote, cheat when the market is positive. They try to be inverse when the market is negative. And that's the goal of an inverse fund, ultimately. So 78% correlation coefficient is a fairly high correlation, meaning that the Russell 2000 is not a very good diversifier of the S&P 500. That's all it means. And so we have to go looking elsewhere for diversification. Okay, so the 0.66. 0.66 is the correlation between non-US companies and the S&P 500. That's better. It's better because it's lower, but it's still fairly high. And it's not 0.66 this year. It's about 0.97. So in recent years, the correlation between S&P 500 and IFA has just been increasing, which in part explains the explosion in the number of ETFs, exchange-traded funds, and the concomitant explosion. Actually, the indexes should come first, the new indexes that are evolved. Then, once you have an index, you have justification for a new product or ETF. And these ETFs are surgically precise. The Norwegian leisure equipment left-handed fund, right? That's the kind of ETFs we're seeing. They are incredibly precise. Why? What are they looking for? They're looking for low correlation. You're trying to find an asset, in this case, a sub asset that has a low demonstrated correlation to the S&P, because the S&P is the deified index. That's my take on why we have such precise ETF instruments now. It's the search for low correlation. Notice commodities. Commodities have an extremely delightful presence in a portfolio because of their historically low correlation to every other asset class. Commodities are what you think they are. Primarily energy. Okay. These data points, the commodities represents the Goldman Sachs, which is now the Standard & Poor's, Goldman Sachs Commodity Index. That's the least diversified commodity index that exists. But that's where we have the data, so that's what I'm using. There are a lot of commodity indexes. And if you're looking for one, the Deutsche Bank Liquid Commodity Index is a better commodity index than Goldman Sachs. So it's petroleum, it's natural gas, it's grains, it's pork bellies, it's orange juice futures, it's that kind of thing. Precious and industrial metals. So this little salsa batch has 7 assets in it, and the average correlation is 0.21. And if 0 means a random correlation, then 0.21 is a very desirable correlation in the aggregate. And then kind of a new idea. We tend to look at correlations specific to 2 assets. I'm more interested in how the salsa tastes, which is the aggregate correlation. So meaningful portfolio diversification requires depth and breadth. Mutual funds and ETFs are depth instruments. With one ticker, you get 500 tickers, right? You buy an ETF, it's a single ticker. It's a single purchase. And you get 500, 2,000, 680, whatever it is, individual tickers in it. That's why they were invented. It's for the facilitation of diversification, but we can't get lulled into a kind of a complacent state where we think that one ticker, because it has 500 large cap US companies, is adequate diversification. It's not. So now we need some number of tickers, each of which, so we need breadth in our tickers, understanding that each ticker has depth under it. So this is a fun sequence of slides because it shows off my ability to do funny things and impressive things with PowerPoint. Of course I had help. So here is a different presentation of this XY graph kind of approach. Remember, this is a 42-year period, so there are 40 3-year periods. So we have 40 3-year returns for cash, right? 40 3-year periods. What's the average of those 40 numbers? They're all 3-year returns. Oh, for cash, just under 6%. What was the 42-year average we looked at? 5.7. So the average of 43 years is very close to the average overall of the 42-year, as it should be. Because why? Because it has a low standard deviation. It's a tight bell curve. Those two should be similar. Well, let's say that we add some bonds. Now we have a 50-50 portfolio. This is our first experiment in asset allocation. We've added tomatoes and onions. We feel very daring. It's a 50-50 portfolio, rebalanced every year. Well, in this kind of graph, what is the ideal? This graph is the rightmost coordinate in the 4-coordinate Cartesian map. We usually focus on just 25% of Descartes' vision of things. The best dimension or zone in this graph is the upper left quadrant, right, the northwest quadrant. So if we ever move straight north, but not east, that was a good outcome. We picked up return and didn't add risk. So adding bonds, now we have a 2-asset portfolio, and we stir it. We stir the salsa once a year, rebalance. We move straight north. Good outcome. Now we add stock. Now we have a 3-ingredient salsa. So our acid allocation is becoming more sophisticated. We move to the north and to the east. We inextricably are brought into higher return. And remember, standard deviation is a measure of volatility of returns. Some of the reasons we can have higher standard deviation is we had more higher returns. Clients aren't bothered by that. Listen, we had too many high returns over the past 10. Can you kind of tone things down? Okay, that's not a typical conversation, I don't think, with a client. So remember that sigma, standard deviation, is the child of up and down returns. You have a lot of up returns, you could still have a higher standard deviation. But it's a different, there's a tone and a color difference. You have to study sigma to really see what it's saying to you. Now we add small stock, non-US stock, real estate. For the students, what does this shape resemble? Let me give you a hint. His name rhymes with Tarkowitz. And he won a Nobel Prize. His first name is Henry Markowitz. This is the efficient frontier. And this is not the way he built it. He had 2 assets. And his model was 100% of this asset, 0 of this. 90% of this asset, 10% of this. And that constellation formed the inverted Nike. This is a very different approach. This is a multi-asset approach, but still, there's an underlying reality that emerges, right? What is it? It's the efficient frontier. It's the notion that the most fascinating part of the efficient frontier is the first part. We actually move back a little bit. You recall the efficient frontier cuts back and then goes northeast. This is the only entertaining part. Everything else we would expect. Of course you add risk to take on the chance for higher return. This is the fascinating part here, where you move northwest. And then we add commodities. And commodities moves us to the northwest. Why? Because it has low correlation. This salsa just passed the taste test. We did something unusual. We added what's perceived as a risky asset and moved to the left. How can you add a risky asset? How can you add jalapeno peppers that are sufficiently hot to melt a person's face? Okay? How can you add them to something that you will then eat? Well, you don't just eat the jalapeno. You add it to other stuff that it tends to neutralize it, enhance it. And for all the nutrition and dietetic students, I know that something amazing happens when you add beans and rice. I don't recall what it is, but it's something amazing, okay, nutritionally speaking. That we might call sort of a dietetic synergy or a food synergy. Can portfolios have synergy where you get more than anticipated because of the combination of the things? Yes. And we can measure it by correlation. We can measure it by the risk-return attributes on a scatter graph such as this. So just, I guess what I'm trying to say is that commodities have been viewed as extraordinarily risky, which totally ignores their correlation to the other asset classes. And that's just a really unfortunate thing because low correlation is really the whole deal when you're building a portfolio. So the next 2 slides violate everything that we know about PowerPoint slides. So there we go. Just take a gander at it for a few moments, and all of the numbers will make sense to you. All I wanted to portray is that we really do have the annual data on the performance of all of these assets back to 1970. I just wanted to, just like due diligence, there's the data. And I wanted to illustrate this far right column These numbers right here in the far right column represent the salsa. In other words, let's take all 7 assets, blend them together, and see what happens. And they're all equally weighted. This is where the salsa metaphor fails a little bit. This means you have equal tomatoes with jalapenos, equal amounts of salt. I wouldn't go there. So just suspend for a moment the salsa metaphor. Relax the conditions. In 73 and 74, those were pretty tough years. U.S. stocks, large and small, non-U.S. stocks had pretty significant losses. An equal-weighted 7-asset portfolio, asset allocation, had a return of 1.5 or 1.6%, minus 5. That's pretty impressive because you had other asset classes, such as commodities. Wow, 75%, that's fun. Bonds, 4.6, cash, 7.5. The whole point is that U.S. stocks or non-U.S. stocks don't always have to carry the load. Other asset classes can carry the load some years. More recent years. Everyone's going to immediately look at 2008, so let's just go there. 2008, the S&P 500 lost 37%. Russell 2000, minus 33.8. EFA, minus 43. Bonds, positive 5.2. Now these are all indexes. These are raw indexes. These are not products. You can't invest in an index. You can only invest in a product that mimics an index. And products are not free. Products have expense ratios. But ETFs have low expense ratios. And so you're close to the raw index to the extent that the maker of the product is true to the index. And that is not always the case. That's what we call index tracking error, either based on high cost or different ideas about what you ought to do relative to the index. So cash 1.5%, which by today's perspective looks rich. Oh, how perspective changes. Real estate, minus 39. Commodities, minus 46.5. I would like to now tell the story of how 2008 played out. 2008, by the end of the third quarter, September 30th, large U.S. stock, small U.S. stock, and non-U.S. stock, the EFA, Morgan Stanley EFA, were pretty deep in the tank, minus 18, minus 22% in that range by the end of Q3, 3/4 of the year in 2008. Real estate, the Dow Jones U.S. Select REIT Index, commodities, the Goldman Sachs Commodity Index, by September 30th, the year-to-date return of those was still positive. What happened was, in the first 6 weeks of Q4, things blew up. So when you yell fire in a theater, bad things happen. That's what happened in our theater. It was a theater of conflict. And when we have panic, we tend to see asset classes move in sort of a herd. And so there was an expression in the countryside that all correlations went to 1. Now, technically, that's not true unless you're monitoring correlations in like 15-minute periods. That's not a terribly valuable period. That's like looking at a young child who's misbehaving and then extrapolating, yep, they're going to be a bad human. Gee, this past 10 minutes has been horrible. That's an inappropriate extrapolation. And so we've seen some inappropriate extrapolations, in my estimation, of correlations over very micro time frames. This is a very long time frame that we've been looking at, 42 years. So things did break down in the first part of the fourth quarter, and these year-end numbers did occur. My point in revealing or talking about what happened through 3/4 of the year is that real estate and commodities, for a person, maybe your client, if they were panicking and forced you as an advisor to sell them out and you didn't want them to, you're the advisor, you could have, quote, sold out of real estate and commodities up until the end of the third quarter without a year-to-date loss in those assets. Not that you're encouraging that, In fact, you might be encouraging them, whatever money they have, things are on sale right now, I'm telling you. That might be another approach. 2001 and 2002, these were more normal bear markets. Oh, for the old days, when we just lost money the old-fashioned way. Notice that a multi-asset approach was quite impressive during a more traditional weakness in equities. So when built correctly, a multi-asset portfolio achieves equity-like returns with bond-like risk. Again, some clients may actually ask for that. We may all want it. Yeah, I'd like equity-like returns, but I don't want the risk. Well, that's the whole point of building a portfolio with multiple assets. So in summary of these data, here's the 42-year return for all of the separate asset classes. The S&P 500 has averaged 9.8% return for the last 42 years, 1970 through 2011. A multi-asset portfolio that has 1/7 large U.S. stock, 1/7 small U.S. stock, 1/7 non-U.S. stock, and so forth, 10.26 average return. Higher than some of the individual ingredients. That's quite fascinating to me. But then I don't get out very often, and these things excite me. So the 42-year sigma, 10.47. What's different about that relationship? Well, the sigma is the same size as the geo mean. Have we seen that before? We haven't. That's a new result. We have seen the relationship between geo mean and sigma that's 2 to 1, 2 sigmas to 1 mean return for the equities. We've seen a sigma to mean return in fixed income of 2/3 to 1. Now we see in an asset allocation model a 1-to-1 correlation between risk and return. I'll take it. I'll take a 1-to-1. I can live with that because I kind of want the equity-like return. Now bear in mind, you don't have to take this approach for your whole portfolio. This idea could be some portion of a portfolio. If you've done a good job saving over the years, do you need a 10% return? You don't. So take less risk. The portfolio that we design should be largely influenced by how much we have saved. If you save more, either you save 10% and earn 6, or you save 2% and have to earn 15. Which one do we control? Well, I think we should be able to control a bit more how much we save. And not pass on to the portfolio the heavy lifting of, hey, you got to get me 14%. To get 14%, you have to dial up the risk meter. And that's where things blow up. Well, enough on that. Year to year. Here are the year-to-year returns of a multi-asset portfolio since 1970. This is how bizarre 2008 was. When you see it graphically, you can see how dramatic 2008 was, as we hope it was an anomaly. Okay, now let me superimpose against this bar chart the returns of just one of the ingredients, the S&P 500. So the blue is now the S&P 500. Notice how many years one single asset class beats the aggregate portfolio. It must beat it 12 times. Which one has the higher average return over 42 years? The tortoise. Because, and this is purely mathematical, when the single asset does more poorly, it does more poorly more often, and it's more severe. And if you lose 100%, for example, excuse me, if you lose, then bad things happen. If you lose 50%, how much do you have to earn to break even? 100%. A 50% gain does not bring you back to whole after a 50% loss. This phenomena is purely governed by math and nothing else. So a large loss is, and it's nonlinear, by the way. This relationship is nonlinear. The larger the loss, the proportionally, non-linearly, the gain has to be higher. So the rule number one of a portfolio is try to avoid large losses and try to minimize the frequency of losses per se. That's what a multi-asset approach does. A single asset can, in any one year, beat a diversified approach. Do you see how many times the blue bar is higher? This is a problem because in those years, the client says, hey, you're losing to the S&P 500. That's like saying, hey, this salsa tastes different than eating just big wads of cilantro. Really? I would have never guessed. You're comparing salsa to a single ingredient. How ridiculous is that? We would never do that. Hey, this salsa tastes different than just ground up tomatoes. What's going on? That's a ridiculous thing to say, and we know it's ridiculous. It's just as ridiculous to compare a portfolio of blended assets to a single asset class. But it happens every day. And that single asset class is called the S&P 500. It's the de facto benchmark for nearly everyone's portfolio. And if we could just stop doing that, we would make some progress. So, how did our asset allocation then end up in get us into this zone, this ideal risk-return zone? It did. We're now inside the loop, so to say. We have a return of over 10% with a risk that's in this middle ground. It's not as low as fixed income, but it's certainly not as high as the single ingredients and those standard deviations. Below it is the classic 60-40 portfolio, 60% US stock, 40% bonds. Okay, that was all introduction. I know that's a horrible thing to say, and so I'll say two other things. I'm almost done, and I know that the brain can absorb, but the butt can endure. So we really are almost done. I would like to introduce what I have come to call the 712 portfolio. And the word 712, the title 712 indicates 7 core asset groups and 12 underlying products. 12 mutual funds, 12 ETFs, 12 whatever you want. But those are the typical ingredients that we would use. Here's the model. And this is the part, Margie, I'm rethinking. This has a US bias. So here's the first ingredient, large US stock. It has 8.33%, because 1 divided by 12 is 8.3%. The next ingredient is a mid-cap US stock, mutual fund, or ETF, and then a small one. Developed non-US, emerging non-US, what Margie was talking about, each having 1/12. Now, what if you wanted, I like the regional thing, by the way. What if you wanted to invert this and have a non-US bias? Then do it. This is a recipe. How many people follow a recipe to the letter? I don't know. I could make up a statistic. Andrew, can you make one up? Okay. Is it 98% of all statistics are made up on the spot? Yeah, that's the joke. Okay. So, real estate, 1/12. Natural resources and commodities. Commodities that's a commodities mutual fund. They own futures contracts. Natural resources is a mutual fund that owns stock in companies. Those are two different things. When you have exposure to a futures contract, that's one thing. When you are long, meaning you own the stock of a company, that's a different thing. These companies in the natural resources sector are companies that mine, refine, package, transport commodities. So they're linked to commodities. But these two mutual funds, these two ETFs, have a lower correlation than these two ingredients. That's the interesting part. So we have eight ingredients that are equity-like. It's a 2/3, 1/3 model, kind of like the old 60-40. 4 ingredients are fixed income, US bonds, inflation-protected bonds. These typically go by the little acronym TIPS, Treasury Inflation Protected Securities, TIPS. These have been in the US since 1998. They've been in Europe longer than that. Non-US bonds and cash. That's the model. 12 ingredients, equally weighted. It's a 2/3, 1/3 overall split. And it represents a balanced portfolio with a US bias, but that can change. I found that I could make a three-dimensional pie chart, and I couldn't resist. That's the only reason I have this, because I already said all that. I recently read Common Sense by Thomas Paine. I would recommend it. But to balance Thomas Paine, you would want to read some of John Adams, just in all fairness. They had different views. The more simple anything is, the less liable it is to be disordered. My contention is, this is pretty straightforward. The model dictates the allocations, and the model dictates a lot of diversification. So the performance over the last 10 years, I'm comparing it against a 60-40 model. So a diversified approach, and these, of course, these slivers or slices of the pie are rebalanced every year. And rebalancing is done a variety of ways. If you add more money, just add more money to which slices? Well, the ones that have fallen below 8.3%. Isn't that a forced buy low protocol? Rebalancing, I'm not an advisor. I deal with a lot of advisors, but I'm not an advisor. The client comes and says, do something. Make it all better. Where's the portfolio Band-Aid? You say, okay, I'll do something. I'll rebalance. All right, good enough. That's the funny part. You're going to do that anyway, right? So do what you're going to do. Maybe do it now as opposed to in 6 weeks, and that may be enough to satisfy the client, that we did something. So it's a built-in rebalancing is a built-in doing something that you're going to do in any event. So 8.57 versus 4.87, so not quite 400 basis points of additional return, which is quite significant. 2008. We all stare at 2008. It's like Waterloo. So this particular 712 model uses actively managed funds. Actively managed funds. The passive 712 model uses ETFs or index funds. It doesn't matter, they're the same thing. Then there's the Vanguard Balanced, which is a 60-40, and then the Vanguard 500, which is the S&P 500. Over the 10 years, 2002 through 2011, 9.2, 857, 487, 282. Now 10 years has been a fairly rough 10 years. Could be even worse if we had 2001 through 2010. It depends how you slice the 10-year window. But 2008, minus 28, minus 24, minus 22, minus 37, all pretty horrible, all qualify as train wrecks. Over the last 3 years, here's an example. Over a 3-year period, this is not a diversified portfolio. This is one asset class. And it beat this 60-40, it beat those 12 asset models. That is an expected characteristic of diversification. You will lose over short time frames to the best individual asset in that time frame. And that is where education is vital. If the client does not understand that this diversified approach will lose to the star player in any given year, they will misunderstand it, and they will bolt. They will leave, because they don't understand the rules of diversification and what it imposes on a portfolio. It's a long-term win, not necessarily a short-term win. Oh, the expense ratio. Costs matter. Using the active funds that I happen to choose for the model, it's about 68 basis points. So that's, let me put it in perspective. if you have $100 in this portfolio, that means that every year, 68 cents comes out as the expense ratio. 31 cents per $100 comes out. And it comes out daily, of course, not all at once. 26.17. I chose Vanguard Balanced and Vanguard 500 because they are very low cost. I didn't want to pick a high cost comparison to sort of stack the deck, you know, against, in favor of the 712. A simple pie chart illustrating the growth of 10,000. But remember, this is a single deposit of 10,000. No additional deposits, no money taken out, and so forth. And that's a reasonably attractive margin of victory over a 10-year period. Now, how do we modify any portfolio to account for people that have different risk appetites? Just scale up. Just scale up on the tips, scale up on the cash. Just overweight those according to their age, usually. But age isn't always the same as risk profile. You can have two 60-year-olds that have very different risk profiles. One 60-year-old has a pension. They've saved $1.7 million. They have good health. They have no debt. That's one 60-year-old. The next 60-year-old, they have a lot of debt, no money in a 401k, no pension. They're caring for sick parents. They're both 60. That's the only thing they have in common. Their portfolios might be very different. That's why age, I want you to acknowledge that age is not a very good indicator of how to design a portfolio. It's the most generic way to present it on a slide like this. So in 2008, for example, a really risk-neutralized version where you have a 40% commitment to the 712 model, 30% in tips, 30% in cash, lost about 9%. It's still horrible, but it's a lot better than minus 30-something or 40-something. This is the most compelling. So I would like to describe this, and then I shall be nearly done. You may have noticed that we live in an aging population base. You may have noted that. I'm already getting AARP materials. I was so proud. So that's an association for retired persons, and they think forward. This is the big deal. For those of you, students or otherwise, who are reading stuff in the journals, reading stuff in the magazines, Financial Advisor magazine, Financial Planning, wherever you're reading, most of the articles pertain to how do we build portfolios for that retirement part of life when we're taking money out of the portfolio. That's the big deal. So I have to ask, is the sequence of returns of a portfolio important with a single lump sum investment? You invest one chunk of money, then wait 40 years. Does the sequence of returns along the way have anything to do with the ending result? Now, if you're nodding your head yes, you're correct on emotional terms, but you're not correct on mathematical terms. The sequence of returns makes no difference over 40 years if it's a lump sum investment. Now, let's say you make investments every year. Let's take a 401k. Does the sequence of returns make a difference? Of course it does, because you'd want better returns late in the cycle, wouldn't you? When you have a bigger balance? Of course. So that makes a difference. How about when you're taking money out of a portfolio? Does the sequence of returns make a difference? Yes, only totally. It makes a huge difference. If you retire, then in that first year, if your portfolio loses 28%, and you also take money out, you're in trouble. So the sequence of returns is vital as we analyze retirement portfolios. So when I subjected the 712 model to that test, I assumed a $250,000 starting balance, a nest egg. Sadly, the Employee Benefits Research Institute, or EBRI, indicates that the average 401k balance for a 65-year-old is about $70,000. That's not solvable with asset allocation. Let me repeat that. An inadequate balance is not solvable with investment theory or asset allocation. It's just not fixable. We have to know what we can do and what we can't do. And we can't fix that. The individual will likely have to continue working. And you maybe don't want to tell them that, so you write a letter. I don't know. So, so if there's adequate money, maybe there's $250,000, and I don't know if that's adequate or not. If they have no debt, maybe it's adequate. So then in this scenario, there was a 5% withdrawal rate. And if there are any of those in this room who are looking for a thesis topic, there are plenty of things you could read about safe withdrawal rates. I would consider Jim Otar, one of the smartest guys in that topic. Bill Bengen has written quite a bit about that. So anyway, for those who are looking for a thesis topic. 5% withdrawal rate. That withdrawal rate, or that cash amount withdrawn, increases 3% a year. That's known as a COLA, cost of living adjustment. So after 10 years, under that scenario, under these assumptions, what was the ending balance? Well, the starting balance was $250,000 right here. This line is the starting balance. If you just invested in the S&P 500 10 years later, after making 10 withdrawals, you took 10 chunks out, your balance was about $160,000, about a $220,000 in Vanguard balance. Your balance was larger than your starting balance in a more diversified approach. And this is during, admittedly, a very difficult 10-year period. That, to me, is the most persuasive aspect of broad diversification. Rebalancing. Basically, do it. Over the 5-year period, 2007 through 2011, 108 basis points benefit to rebalance the portfolio annually, once a year. Most advisors charge 1 percentage point or 100 basis points. If the only thing you did, which of course it isn't the only thing you do, but if it was the only thing you did, if you just rebalanced your clients, you would earn them, in this particular case, you earned back your fee, if that's the only thing you did. But there's a lot more to do. Over 10 years, it wasn't that large. It was about 40-something basis points, but still half your fee. I wrote a book. There it is. It's very clever. I did not think of the title cover, but can you see 712 in the Roman numerals? Yeah, it took me hours. My 12-year-old daughter saw it immediately. Oh, cool, Dad. What? What? You don't see it? What? Right? So the white is the 7, and then the 12 little thing. I wish I had thought of it. I did not. My vision of the cover was a bunch of salsa ingredients. And frankly, some years ago, I had hoped to persuade a publisher to use a title that I still would like to use, which is Investment Soup for the Chicken Soul. Hasn't worked out yet. I put quite a bit of information on my website, 712portfolio.com. You're just welcome to download whatever you want. There's a spreadsheet that you can download that's kind of fun. If you have no life, you go through that kind of stuff. Questions, comments? That's the last slide. I guess we have just one before you.
Yeah, I just wanted to see if you had a chance to look at any of the data if you rebalanced on a 6-month basis or 3 times a year and what effect that would have.
Yeah, I can tell you that balancing monthly tends to be the worst performance. It's kind of like stirring the rice too often. I don't know anything about rice. I shouldn't have said that. Apparently, you're not supposed to stir rice very often. It gets sticky or something, or it turns into macaroni. I don't know what happens, but monthly is the worst. Quarterly and annual are the best, and we're talking about margins of difference of maybe 30 to 50 basis points. So is it dramatic? No, I don't know. I think so. I think 50 basis points is actually pretty dramatic. So, and plus monthly is more work. We all want to avoid that. Oh, I'm sorry. Yeah, you want the plot. If we rebalance monthly, our returns tend to be about anywhere from 80 to 30 basis points lower than if we rebalance quarterly or annually. So I would just suggest annually rebalancing is the best protocol. Bob?
In fact, I've had clients ask me about that, and the Journal of Financial Planning over the last 5 to 10 years has actually had articles that proves, long academic articles, that proves rebalancing monthly is not good for your portfolio. But I'm also very much aware that there are firms in this country, even in this state, that sell the idea to the client, we will rebalance monthly for you, and they're full of shit, okay? Now, he put it more academically, but I'm telling my clients the truth, okay? By the way,
Bob said.
I have read over 100 books in the last 43 years that I've been doing this work on asset allocation models. I still only have about 60 of them on my shelves behind my desk. This is the best one I've ever read. And I even hand it out to a lot of my clients who want to do it themselves. So I love it. Thank you, Craig.
Thank you, Bob. Appreciate that. Give you a 20 later.
You did not bring books to sell, and why not?
That seemed oafish. I thought about it, but I didn't want to check a bag.
It's not, actually.
Not oafish?
No, there are those of us amongst here who are actually interested in our own pocketbooks.
Oh, yeah, that.
That's not oafish, that's self-interest.
I appreciate your saying that. If you will go on my website, sorry, that was out loud. I purchased a large number of books because they were, John Wiley is the publisher, and they wanted, I guess, to move some out of a warehouse. So as I buy them or they burn them, okay, I'll buy them. And so if you will just email me, I can sell them for it's about $26 on Amazon.
And that's www.712 portfolio.
Or my email is directly right above it. And I'm happy to sell at my cost plus whatever, like maybe it's $12 with shipping or something. I'm happy to do that. I appreciate your asking.
Could I ask another question?
Yeah.
I was really impressed with those 40-year rolling charts of yours. I wonder if you'd ever looked at the changes in the correlation of each asset class against all the others over 40 years, and have there been changes in
Here's the 40-year, here's the rolling 10-year I took these slides out because I was going to be, I think, pressed for time. So to your question, here's the rolling correlations of large stock to small stock, 10-year windows. So each black dot is a 10-year rolling correlation. So small stocks and large stocks tend to have a pretty consistently high correlation. Is this what you're asking?
close? It's the allocation of large U.S. stock to the other, all of the other classes.
Oh,
And then,
that correlates.
and then optimizing the dollars that go into each asset class based on the correlations.
Yeah, that's a great question. I can do that. I haven't done that. Optimizing is a trick because to optimize based on historical correlations is not too unlike driving by looking through the rearview mirror, which I think my kids do actually on occasion. It's historical optimizing is what that would be. And it's not a bad approach. We just have to understand that it's not really it's risky in that regard.
Well, has there been much change in 40 years' time? Maybe that's a simpler way to put it.
Okay, but yeah, let me show you. This is not exactly what you asked because these are binary correlations, 1-to-1 versus 1-to-6, which is what you're asking. Yeah. But here's the U.S. stock to the international stock. Look at what's happened in correlations over the last, say, 15 years. that's the spiking in the correlation pattern that has led to, like I mentioned earlier, lots of very precise ETFs that have almost nothing. Here's you have X shares in New York, and they have the Iceland ETF. I don't even know where Iceland is, right? And so it's not even in, I don't know, maybe it's in the IFA, I don't know where it is. But it's a very specific application outside the US and probably has a lot lower correlation because we don't know where it is yet, right? We can't locate it. So here's the correlation from stocks to REITs, really a volatile pattern of correlation. So when people say, look at the correlations right now, how high they are. Look back here, how high they were. There's really nothing new under the sun. We just have more precise ways to do it. Commodities, a very volatile correlation pattern. So when they're high, it's not as if they've never been high before. We've seen it before. It's just when they're high, it bugs us because we're alive now. And we weren't maybe alive back then, so we don't care about that. Bonds, that's a very intriguing pattern, correlation to bonds. Almost looks like a huge sine wave kind of potential correlation pattern. Great question. If you will email me, I can quickly run that correlation of the rolling 10 of the S&P to the other 6.
Thank you, and I'll put in a plug for your recent book, too.
Oh, thank you. I'm out of 20s. Other questions, comments, concerns?
Could you put your email back up again, please?
Sure. Yeah. Gordon?
Do you have any observations to make as to what would be the effect on applying the approach you're presenting if you use a responsibly social screen
Yes.
on the underlying funds?
Excellent. Yeah, this is Gordon Bivens, by the way. I have a partial 712 that I've built. In other words, SRI investing or socially conscious investing. You don't have SRI funds in all 12 categories, but you do have it in U.S. large cap, non-U.S. large cap, you have it there. There's maybe 4 or 5 categories of the 12, and Gordon, if you can just remind me, I will send you that model, the tickers of that model. Okay. I will say that socially responsible investing, the 3 most typical industries or industries that it shuns are alcohol and tobacco and casinos/gambling. So alcohol, tobacco, and gambling. Those are the 3 most common filters that an SRI fund would move out. Interestingly, those industries are quite profitable. And so when you move those out, then there's room for other industries, and there's other filters, companies that test shampoo on dogs and just a variety of things. And you may be more sensitive to one filter versus another. Hiring practices, there's a lot of really valuable filters. So it may be that in some cases an SRI fund, mutual fund, has a little bit lower performance. And that was true 15 years ago. It's less true today. Since we have more exposure to more industries, both here and abroad, we fill in those gaps that are now created with the filters with other reputable, more admirable, based on your perspective, industries. So the gap is closing. SRI is less painful if you just are looking only at returns compared to 20 years ago. I know that I stand between you and total happiness. Thank you.